Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. So the moment of truth is less than 24 hours away. That's when Nvidia will report its results tomorrow after the closing bell in the States. Now on Tuesday, its shares were down 2.8%, bouncing right off their 100-day moving average. Nvidia's market cap is now about $4.4 trillion. That is larger than the energy, the materials, and the real estate sectors combined. So calling this report critical may be an understatement. For a closer look now, I'm joined by Jed Ellerbrook. He is portfolio manager at Mechant Capital Management. Jed, thank you so much for making time. Are you optimistic on this Nvidia story still?
Yeah, I am. I think Nvidia is going to report outstanding earnings tomorrow evening. I think everybody knows that. Biggest question is, where does revenue guidance for next quarter end up? I think something over 63 billion would probably get a green light from investors. But just stepping back, the company continues to grow at an incredible rate. The demand for their products is enormous. Their competitive advantage over their peers remains wide. And the company is leading. Their products are the infrastructure that's allowing for this AI revolution to unfold.
So Microsoft and Nvidia today kind of announced the commitment to invest a combined $15 billion in Anthropic, which is obviously a rival firm to OpenAI. And at the same time, we learned that Anthropic is intending to buy $30 billion in cloud computing power from Microsoft's Azure service. This seems to feel a little like circular financing, does it not? And I'm wondering whether that concerns you a bit.
Yeah, there is an aspect of circular financing to a lot of these deals. It doesn't concern me terribly. I think that all the models are going to be available on all the clouds. We've pretty much reached that stage at this point, with OpenAI available on AWS and now Anthropic available soon on Azure. NVIDIA chips are exceptionally important for all the hyperscalers. They're buying them aggressively. They'll buy a lot more next year than they did this year. The circular financing doesn't concern me terribly because NVIDIA is doing it with their profits. They're using cash flow. It's a debt-free balance sheet, and they're just taking their profits, their annual cash flow, and investing it back in the ecosystem to try to accelerate AI growth. They're making wise investments. Their investment in CoreWeave, for example, from 2 or 3 years ago has turned out very well. I think their investment in a lot of these leading model players like OpenAI and Anthropic and many of the other AI ecosystem companies will be more successful than not. So it's an aggressive strategy, certainly. You can criticize it, but I think it's prudent business and seeding the ecosystem. And I think it's worked well for NVIDIA thus far. And the company has a debt-free balance sheet.
So some of the hyperscalers have been using debt as a way of financing this build out. I think in total, they've sold so far this year high-grade notes totaling around 121 billion in U.S. dollar terms. That seems like a phenomenal amount. Many times what we have seen over the last 5 years, I think that 5-year average over each of the last 5 years is around $28 billion. And I understand the appetite for the build-out, yes, but financing through debt, is that a concern at all?
Yeah, I think it is. I think that you just have to acknowledge the AI build-out up through, say, mid-year this year, mid-year 2025, was financed almost entirely with the operating cash flows of the big tech companies in America. Now we have pivoted, we're spending beyond that now in some cases. And, now a decent chunk, maybe a quarter of the next year's build out will be financed with debt. These big tech companies, though, their balance sheets remain in a net cash position in all but one or two circumstances. Oracle is obviously an outlier on the aggressive side. They have, debt to EBITDA north of 3 times, which is, reasonably high. CoreWeave is pretty aggressively financed. They have a lot of debt. But Amazon, Google, Microsoft remain in a net cash position. They are borrowing some, but they remain in a net cash position overall. Meta, I think, is on the aggressive side too. They're spending super aggressively to build data centers for their own use. And they are doing some off-balance sheet financing to fund that. And they're smaller than Google, Microsoft, and Amazon in terms of annual cash flow. So they need to rely on borrowing some. But I think the core three, Amazon, Microsoft, and Google remain in a net cash position. They borrow occasionally just to manage their balance sheet, but they remain in exceptionally strong competitive, positions, exceptionally strong cash flow, and their cash flows are growing north of 15% per year.
Are you concerned at all about the level of concentration when we look at some of these big tech names and the degree to which they're influencing so much of the market's behavior?
Yeah, absolutely. We're in a very different investing landscape in large cap US equities today compared to 5, 10, 20, or 30 years ago. The big tech companies are, more than a third of the S&P 500. Nvidia is over 8%, I believe, of the S&P 500 today. Microsoft and Apple aren't far behind. So yeah, the rising market concentration amongst US equities is different, and it does bring about some risks, and it's something investors need to weigh carefully. Investors want returns, of course, but they also want balance and diversification. And the S&P 500, large cap US equities, are becoming less diversified, less balanced by the month.
No doubt these mega cap companies have been really, really innovative in terms of creating new technologies. Obviously, AI is a big part of the story, but I'm wondering if you look offshore to a place like China, are you concerned about maybe an unknown there that could deliver a level of competition that the market's not prepared for?
Yeah, I think that, Chinese LLM developers are just a couple months behind the leading US labs. And that gap has been shrinking over the last 2 years. We've seen some big events like DeepSeek and the new Kimi model that are big steps up for the Chinese models. So yeah, there is intense competition. China has plenty of power, but not great supply of chips. United States, not enough power, plenty of chips. So they each have their strengths. They each have their weaknesses. They're both working to shore up their weaknesses as quickly as they can, and it's intensely competitive, and that's going to remain the case. And then, of course, you've got, Taiwan, which exports most of the most advanced accelerator chips that are relied on for AI use cases. So that is another flashpoint.
I read an article a couple of weeks back about a new analog chip produced in China that was reportedly 1,000 times more efficient than some of the most advanced chips that Nvidia has designed. I mean, when you hear a story like that, you have to be a little concerned that maybe there is something happening that we're not completely aware of that could cause major disruptions. Does that eat up any of your thinking at all?
Yeah, sure, it has to. You have to pay attention to some of the outlier risks. I would want to, before I put a lot of credence in that particular story, I would want to see those chips performing out in the wild, out in data centers. Outside of China, just to verify and confirm that and see it for myself. So a little skeptical and waiting for some demonstrations of use cases.
Is there a way that you're playing this trade that may be a little counterintuitive, or are you just kind of following, I don't want to say following the herd necessarily, but adopting pretty much a mainstream approach in applying capital to this segment of the market?
I think what we're trying to do is a little bit different. We are focused on investing in companies that we believe will be, outperformers, whether AI achieves the most wild, aggressive predictions or not. So, for example, Amazon, we're confident. We believe that if AI becomes all that the technologists hope and expect over the next 5 years, that Amazon will be a successful, outperforming business. But if AI falls short, if AI development is a couple years behind the timelines people project and expect, Amazon's going to do well in that scenario too, because their existing businesses are performing really well. They've got a lot of non-AI revenue. So we're trying to cover our bases as much as possible, and we're trying to acknowledge that there are a lot of future, growth paths for AI.
Jed, we'll leave it there. Thank you so very much. Jed Ellerbrook is portfolio manager at Argent Capital Management, joining us here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. There was a defensive tone in U.S. stock trading in the last session in front of those earnings from Nvidia. We had shares dropping about 2.8%, bouncing right off their 100-day moving average. Nvidia's market cap is now $4.4 trillion. That is larger than the energy, the materials, and the real estate sectors combined. So calling the earnings report critical may be an understatement. Now, the recent selling that we have seen in shares, not only in Nvidia, but other tech giants, has reignited this debate on AI and whether the industry is generating enough revenue or profit to justify this massive build-out in infrastructure. Gorilla Technology Group is a full-stack builder and operator of sovereign AI infrastructure. Here is Gorilla CEO Jay Chandan on one of the major challenges facing the industry during this current build-out.
The biggest challenge we have today is that, there are no standards or protocols that can be adopted today. The world is building to it. The problem being that different nations are building at different paces today. The issue we have today is that we don't have one uniformed platform that we can subscribe to. And what Gorilla is doing is that we're working with governments across the organizations today. We're making sure that we're able to support and build these infrastructure platforms so that we can have a unified protocol across the region today.
That's Jay Chandan. He is the CEO of Gorilla Technology Group. Now, the outlook from Nvidia in particular could have significant impact on markets. The bar has been getting higher for this chip maker to convince investors that the billions spent on AI will pay off. So we got some perspective from the market side from Bob Diamond. He is the former CEO of Barclays, and he spoke with Bloomberg TV host Shery and Avril at the Bloomberg New Economy Forum in Singapore.
We're repricing risk in a way. It's equities, it's AI, it's Bitcoin, it's really across the piece. So I don't think this is specifically about crypto or digital assets. I think for us, what's really interesting is we're a big investor in Hype, the native token of Hyperliquid. Hyperliquid, as you know, is developed right here in Singapore by Jeff Yan and his team, and it's a decentralized, non-custodian exchange. And its native token Hype over the last 7 days is up a bit, where Bitcoin and most of the other tokens are down. But I would say that's rare. It's unusual. Really, across the piece, we've seen risk assets be repriced. In my sense, this is a healthy correction, not something that's turning into a bear market. So I think for many reasons, I was just at the GIC Insights over the last day. Anybody associated with GIC, appreciates who they bring together once a year to talk about these trends. And, one of the things we were talking about there was the big numbers in AI. I mean, the billions here, trillions there, billions here, data centers. And I think most people have a hard time really processing it. And that doesn't really work against the fact that we can be really, really positive on AI over the next 5 to 10 years and the impact it's going to have.
But the big numbers are scary,
They're
especially
big.
at a time when they continue to invest in sort of each other,
all
right?
Over the place. Yeah.
And these concerns about a circular deal, about whether this is just a bubble.
Yeah.
So you don't buy into that. Will there be demand down the line?
What I feel comfortable in is taking a 2, 3, 5-year view of the impact of AI. I think it will be a real positive in dampening inflation. I think it's going to be incredibly important in terms of productivity in the global economy. And I think some people are confused right now over the valuations. And many people say this. They look back, to the internet bubble in 2000, right? It had a real bubble because there was some fringe equities that probably weren't legitimate as much as kind of the core. But nothing stopped the development of the internet over the next 10, 15, 20 years. And I think the consensus over the last day has been where really we, the group, are very, very positive on what AI can bring in terms of productivity, dampening inflation, global growth, really comfortable. So I think this is a correction in risk assets across the piece. And I think, AI, partly because there's so many big numbers out there, that people really don't understand yet, in particularly around data centers.
Yeah, I think it's hard to decipher. And to your point about the internet economy, it was also about sifting out the froth at that stage early on in the game. When it comes to digital assets, you look at tokenization, as you highlighted earlier, as a key driver. How are you viewing, say, stable coins and how that might be shaping the financial system?
Well, that's the other big investment we made at Atlas Mechant Capital. We're an early investor in Circle in 2021. We've worked with Jeremy Allaire and his team very closely over the years. They have a tremendous relationship here in Singapore with the Monetary Authority of Singapore and the developments that they've had. And I think we've learned so much about the impact of blockchain in terms of, we believe, will be a real source of the underlying foundation of financial services over the next 2, 3, 5 years. Stable coins are really here to stay. And I think the acceptance of Circle as the most regulated, the most conservative, really has reserves behind it that are managed by BlackRock, as you know. So I think the best of the best in stablecoins is Circle, highly regulated. They want to be highly regulated. They want to be an OCC bank in the U.S. So I think the developments there are very strong. And I think what we've seen this year is a sea change in the U.S. in terms of tailwinds. With this administration, with Scott Bessent in the Treasury, with Paul Atkins in the SEC, with Jay Clayton, this team is so highly respected and so supportive of regulation that covers both digital assets and financial services, not two separate regulatory.
What else in your mind in terms of deliverables left to go on these regulatory guardrails for the environment?
Well, I think the most important thing from my point of view is we look at stablecoins is the increase in institutional use. You know, a move from crypto traders using stablecoins and using digital currencies to treasurers, to Visa and MasterCard, to the big banks like JP Morgan and B of A developing it. We're certainly seeing in the Middle East with some of the best banks in Abu Dhabi and Dubai already developing use cases for blockchain and stablecoin, particularly dollar stablecoins, particularly USDC.
So I know that you talked about perhaps the U.S. regional banks and the consolidation in that sector, right? What scares me right now is all the froth, not only in the crypto space, but of course we talked about tech and the buildup around artificial intelligence. Where do you go to hide when you could potentially see, as Jamie Dimon said, cockroaches, one means more, and you've seen even around banks in the U.S. where you had isolated incidents with Tricolor or First Brand. So is there a hedging mechanism at the moment?
Well, I think there's two different questions there. In terms of the comment on cockroaches, I mean, I think it was a statement of credit.
Credit.
And if we're being very, very honest with ourselves, you know, we had 12 years of zero interest rates after the great financial crisis in 2008. Then we had a steep increase from 0 to 5.5%. I would have thought back then we would have seen cracks in credit because it was such a long period of credit was really very, very available. And I think today it would be unsurprising to me, given how tight credit spreads are, that we see some correction in credit spreads.
To be fair, a lot of people say that credit spreads are tight right now because they're not really thinking about the fiscal risk that's already baked in, because you can't even really count on sovereigns at the moment with their building debt load that they're actually safe.
Well, you have, I think, Shery, what you just brought up is the darkest cloud overhanging the markets, which are the debt levels. You know, we're talking about the credit markets, but what you're referring to now is sovereign credit, and in particular from the U.S. and the much higher debt levels. And that is the dark cloud hanging over the market for sure.
What about PE? How are you approaching fundraising going into next year?
You know, with all this volatility, it makes what we do in private equity even more sustainable. And I think when you look at you know, the correction in equities, for example, in the U.S., it's primarily around those 7 or 8 or 9 equities in tech that have really been leading the rally. You move from that to the smaller companies in the index, and then you move from that to the private companies. We're seeing very, very good opportunities in private equity. We focus on financial services. We do a lot in the U.S. One of the things that we see as a terrific opportunity is consolidation in regional and community banks, their ability to pull costs out, to create cost synergies almost immediately with consolidation. I mean, particularly here, when I mention to people that there's 4,500 banks in the U.S., they usually look at me like, what?
Yeah.
And you see
the United States has 4,500 banks, and they're really good. And as Scott Bessent, the Secretary of the Treasury, has pointed out many times, about half of the lending to small businesses in the U.S. come from regional and community banks, not from kind of the big four. So there are a lot of great opportunities out there in private markets.
That is Bob Diamond, the former CEO of Barclays, in conversation with Bloomberg TV host Shery and Avril Hong at the Bloomberg New Economy Forum in Singapore, here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.